Welcome back to Investing Talk Podcast.
Today we're looking at Nebius Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. Let's just get straight into this.
Right, so we have a really interesting setup today. We are breaking down Nebius Group, ticker NBIS. And right off the bat, I want to set the stage because it is really easy to glance at this and just see another, wild volatility play in the tech sector.
Yeah, just another high-flying AI ticker.
Exactly. But Nebius is positioning itself as something very specific. It's a full-stack alternative to the hyperscalers. So think of your Amazon AWS, your Microsoft Azure, but built exclusively for the AI boom.
Okay, hold on. I have to play the skeptic immediately here because, AI infrastructure is a great buzzword. We hear it all the time. But when I look at the hard numbers, I see a company with a $28 billion market cap that just posted a massive net loss.
Right.
I mean, we are talking about deep red ink here. So before we get too excited about, the future of compute, we really have to ask the hard question. Is this just a cash-burning machine riding a hype wave? Or is it actually the next essential layer of global infrastructure? Because right now, the financials just look messy to me.
And that is the conflict. I mean, that's the billion-dollar question right there. But here is the so what for you listening right now. If you believe that AI demand, specifically for high-performance compute, is going to outstrip supply for the next decade, you need infrastructure that isn't just a commodity.
Okay.
You need someone who owns the whole stack, from the metal all the way up to the software. And Nebius is trading around $107 right now. And despite those mixed earnings you just mentioned, the institutional interest is huge. There's a reason the smart money is looking past the loss.
Well, let's unpack those fundamentals then. Because the market can stay irrational longer than I can stay solvent. But eventually, math matters.
So let's look at the Q4 2025 results.
Because it wasn't a clean beat. They missed on revenue. And the net loss, $249.6 million.
Yeah, that's a big number.
That is $250 million gone in 3 months. For a company valued at $28 billion, that's a scary burn rate. You really can't just wave that away.
I see the loss, and I totally hear the concern, but you have to look at the composition of that loss.
Yeah.
In infrastructure, not all losses are created equal. The report highlighted very large AI cloud revenue growth. That is the signal in the noise.
So the top line for cloud is moving.
Exactly. The
Right.
core engine, the AI infrastructure segment, is accelerating. You have to remember, this is an infrastructure stage company. They're building physical data centers. They're purchasing massive amounts of NVIDIA H100 and H200 GPUs, and they're deploying these clusters across Europe and North America. You don't build a factory for free, right?
Sure. Yeah.
That loss is essentially capital expenditure masking itself as an operating loss in the growth phase.
Look, I get the spend money to make money argument. Amazon obviously did it for years. But usually you want to see the revenue catch up a bit faster. Right now, the PE ratio is sitting at 253.30.
Right.
253. That is pricing in absolute perfection.
Are we sure the market isn't just getting way ahead of itself here? That multiple leaves zero room for error.
It is high. I'll grant you that. It's nosebleed territory if you just look at the trailing 12 months. But a PE of 253 suggests the market is pricing in a profitability inflection. Investors are betting that once this capacity actually comes online, once those GPU clusters are fully rented out to AI developers, the margins are going to flip almost overnight.
Because the hard part is done.
Right. It's about operational leverage. In cloud compute, your fixed costs are massive. Buying the chips, securing the real estate, cooling the centers. But once those are paid for, the incremental margin on renting that compute out is huge. The market is valuing them on 2027 earnings, not their 2025 losses.
So you're basically paying for the hockey stick graph that hasn't actually happened yet. You're paying for the moat that makes the hockey stick possible. And this is where it gets really interesting. We really need to dig into their competitive moat because Nebius isn't just renting out GPUs. They aren't just a landlord for NVIDIA chips. If they were, they'd be dead in the water against AWS or Google.
Right. I've seen they claim to be vertically integrated. But, that's a phrase every tech CEO throws around on an earnings call to sound sophisticated. What does that actually mean for the investor holding the bag?
It means they own the cloud platform, the proprietary software, and the R&D. But look at their acquisitions. This is the key that most retail investors totally miss. They recently acquired a company called Tavily.
Tavily. Yeah, I saw that. Why does a search company matter for an infrastructure play? It just feels really disconnected to me.
It feels disconnected until you understand AI agents. See, LLMs, like the ones behind ChatGPT, are generally frozen in time. They only know what they were trained on up to a certain date. To be useful for finance or coding, an AI agent needs to browse the web in real time to get current data. Tavily builds search APIs specifically for those AI agents. It provides that connection to the live web. By buying them, Nebius isn't just selling you the raw electricity to run the model, they're selling you the tools to make the model smart and functional.
So it's the difference between selling the empty plot of land and selling the plumbing and internet connection along with it.
Exactly. It creates lock-in. And
Right.
it's not just Tavily. They have Avrita, which is their autonomous driving IP, and Toloka, which is their data labeling unit. If you're a developer using Nebius for your compute and you start using their data tools and their agent software,
It's hard to leave.
it becomes very hard to leave. You're in the ecosystem. It stops being a commodity service where you just jump to whoever's 1 cent cheaper per hour. This is how they prevent AWS from crushing them on price. They make the switching costs too high.
Okay, that does make the valuation a little more palatable. If they can actually pull off that ecosystem play, it prevents the race to the bottom. But let's look at the financial health again. $28.13 billion market cap. They have a global footprint. Europe, North America, the Middle East. They're deploying capital super aggressively. My concern is, can they capture market share before the big guys just wake up and crush them? The hyperscalers have deeper pockets and existing relationships with every Fortune 500 company on the planet.
That's the race. But Nebius has a unique advantage. They are purpose-built for AI. The hyperscalers have a lot of legacy baggage. Old servers, old architecture, old pricing models. Nebius is nimble. They can deploy these specific high-density GPU clusters faster. And right now, in the AI arms race, speed is really the only metric that matters to the AI labs. If you have the chips available today, you win the contract. Nebius is optimizing for availability and low latency in a way the giants are struggling to pivot toward quickly enough.
Okay, so fundamentally, it's a high-risk, high-reward infrastructure play with a software twist to protect those margins. Let's pivot to the charts and see what the price action tells us, because honestly, sometimes the chart knows things the balance sheet doesn't.
Absolutely. The technicals here tell a really clear story of accumulation.
So we're currently sitting around $107.38,
Yeah.
and the stock has been on a wild ride. The 52-week low was $18.31. It's gone up almost 6 times from the lows. But it is currently about 24% below its 52-week high of $141.10.
Yeah.
That's a pretty significant correction.
Which creates a very interesting technical setup. If you look at the chart, we are seeing a classic bull flag pattern.
Break that down for the listener who isn't staring at a trading screen right now. Why isn't this just a dead cat bounce or a full trend reversal?
Good question. A dead cat bounce usually happens on low volume after a crash. This is different. Imagine a flagpole. That's the steep uptrend where the stock rallied hard from $18 up to $141. Then, the flag is the consolidation phase we're in right now. The stock pulls back slightly, trades sideways. It's the market digesting those massive gains. A bull flag usually suggests that the buyers are just resting before the next leg up. It's a transfer of ownership from the short-term traders taking profits to the long-term holders building positions.
So we're in the flag part right now, just sitting in the waiting room.
Exactly. We're in what I'd call a pullback zone. The stock is cooling off from that high of 141. For a trader, this is often the ideal entry point. You don't want to buy at the absolute peak. You want to buy when it dips and consolidates right before it retests those highs.
But how do we know it's just a pause and not a reversal? How do we know people aren't just quietly dumping the stock because of that earnings miss?
Volume. Volume is the ultimate lie detector in the market. Look at February 19, 2026. Trading volume spiked to 17.31 million shares. The average is usually around 16 million.
So higher volume on the dip, that usually implies selling pressure.
Or absorption. Look at the price action on that volume. The stock didn't crash. It stabilized. That tells me this is institutional accumulation. When you see a stock report, a net loss, missed revenue, and yet big money steps in to buy over 17 million shares the next day. That is not retail investors like you and me buying a few shares on our phones. That is institutional conviction. They are buying the dip because they're looking at that 2027 profitability, not the 2025 loss. They're just absorbing the weak hands.
That is a very fair point. If everyone was truly panicking, the price would be cratering on that volume, not just forming a sideways flag. The price stability in the face of bad news is definitely telling.
Precisely. It's resilience.
Well, charts are one thing, but let's look at what the street is actually saying. Analysts seem to be singing a very specific tune right now, and I want to know if they're just following the herd.
They are singing a very bullish tune, but their targets are quite specific.
I'm looking at the notes here. Compass Point. They initiated coverage on February 18th, 2026. What was their call?
They came in with a buy rating and a $150 price target.
150. We're at 107. That implies nearly 40% upside from here. That's not a conservative target at all.
Right. And it wasn't just them. BWS Financial, who have been covering it for a while, maintained their buy rating on February 17th, even after seeing the earnings miss. Their target is $130. So you have a solid consensus building between $130 and $150. These analysts are looking at the forward guidance, specifically the cloud revenue growth rate, and they're modeling out that exact inflection point we talked about earlier.
This brings up a really fascinating bit of market psychology for me. We saw the headline. Nebius misses, guides low, stock rips. Or at least it didn't crash, it held up.
That is the ultimate tell. In trading, the reaction to the news is always more important than the news itself. When a company gives you bad news, a revenue miss, a big loss, and the stock just refuses to go down, that means the sellers are exhausted. It means the market has already priced in the bad news and is purely looking forward. They're ignoring the current loss to bet on the long-term AI growth story.
But it's not all sunshine. I have to point out the insider activity. I'm looking at Form 144 filings from late December 2025. There was insider selling. If the management is so confident about this 2027 inflection, why are they cashing out? That always makes me nervous.
I looked at that too. It's a yellow flag. I'll agree with you there. But honestly, looking at the amounts and the timing, it looks like standard tax and portfolio rebalancing. It was end-of-year stuff, there wasn't any panic selling, and no massive blocks that would indicate a real lack of faith. And more importantly, that selling is heavily outweighed by this new wave of institutional coverage. Yeah. When you have Compass Point and BWS pounding the table, that liquidity absorbs the insider selling easily. The flow of money is net positive into the stock.
Okay, so the smart money on Wall Street is buying, and the insiders are just doing some end-of-year housekeeping. What are we watching for next? What is actually on the catalyst calendar?
We obviously just had the earnings, but we are looking closely for the earnings call details, specifically any guidance on margin expansion. We're also expecting a potential analyst day in Q1 and crucial updates on how they are integrating Tavily. If they can show that the Tavily software is actually driving cloud consumption, meaning if they can prove the cross-sell works, that is the definitive proof of concept for their entire ecosystem strategy.
We can't ignore the risks, though. Let's look at the bear case, because as much as I love a good growth story, I worry about the macro picture, and frankly, I worry about the hardware itself.
It's healthy to worry. What's keeping you up at night on this one?
Risk number one is the profitability gap. I'm going to keep hammering this $249.6 million loss. If that inflection point to profitability gets pushed, say it doesn't happen in 2026, say it gets pushed to 2027 or even 2028, that multiple, that PE of 253, it collapses. This is a massive timing risk. If they run out of cash or market patience before they turn a profit, the stock gets crushed.
That is highly valid. If the timeline extends, the multiple contracts. The market is pricing in perfect execution right now. Any stumble in their deployment delays revenue, and that just burns more cash.
And risk number two, the AI bubble. But I wanted to get specific here. I've been reading this bearish commentary about 22 reasons AI data center construction is in a bubble. My specific fear is actually depreciation. Nebius is spending billions on H100 chips. What happens when NVIDIA releases the next generation, or the one after that? These chips are rapidly depreciating assets. If enterprise AI spending slows down, or if there's a glut of data center capacity, Nebius could be left holding a lot of very expensive idle hardware that is becoming totally obsolete.
That is the nightmare scenario for the whole sector. Hardware deflation is real. If the bubble bursts, everyone gets wet and the hardware owners drown. But here is the mitigation, and it goes right back to what we discussed earlier, stickiness.
The ecosystem argument again?
Yes, it's their only real hedge. Nebius has the Nebius Academy. They have the software stack with Toloka and ClickHouse. They aren't just selling raw, commoditized server space that becomes worthless in a supply glut. They are deeply integrated into their customers' workflows. That makes them far less vulnerable than a company that just rents raw space. If you are using their proprietary database and their agent tools, you aren't going to switch just because Amazon drops their hourly rate by 5%. The software creates the barrier to exit.
So the software is the hedge against the hardware bubble. They're trying to be the iPhone, not just the battery manufacturer.
Exactly. It provides a defensive moat in a downturn.
So how do we grade this opportunity? We've looked at the ugly financials, the beautiful technicals, the bullish analysts, and the scary macro risks. What is the final score?
Taking everything into account, the tech stack, the market position, and the chart setup, I'm giving this a bullish score of 8.2 out of 10.
8.2. That is pretty high given the net loss.
It is aggressive.
Oh,
But here is the thesis. This is a 6 to 12-month swing trade. We aren't marrying the stock for 20 years necessarily, but the setup right now is potent. The thesis entirely relies on the company pivoting from heavy investment to profitability.
it's an inflection play. You're buying the turn.
Completely. And the key drivers are there. You have strong institutional conviction. Those $130 or $150 targets are no joke. You have very large cloud revenue growth, which proves the demand is actually there. And you have the strategic expansion into software with Tavily, which proves the management is thinking long-term about value, not just dumping hardware on the market.
So the trade is to catch the breakout.
The trade is looking for a breakout from this bull flag pattern. We're at $107. If it breaks out, we're looking for a run toward that $150 compass point target. The risk reward is asymmetric. You have a defined floor around that $100 level where support has held strong, and huge upside if the momentum continues.
But, and here's my final warning for you listening, position sizing is key. This is not a savings bond. This is a company executing a high-wire act, building physical infrastructure in a highly volatile market. Do not bet the farm on it. If that macro bubble bursts, that 8.2 score drops to a 0 real quick.
Absolutely. High conviction, but manage your risk. Stop losses are your best friend here. If you found this breakdown helpful, please make sure to subscribe, like, and comment to support the channel. We will be tracking Nebius very closely over the next few quarters to see if they hit that inflection point.
Thanks for tuning into the Investing Talk podcast. We'll see you on the next one.